Welcome back to Golden Rule Radio. And in anticipation of another rate cut next week, I sit around the table with my fellow boneheads who also don't want the rates to go zero or negative, or maybe it's just the speed at which we want them going down. Because I do think the Fed wants zero and negative interest rates. I think the IMF report we talked about a couple weeks ago hints at that. But I guess for Trump's sake, we're not doing it fast enough. So how are the markets reacting to the expectation of interest rate cuts next week? Let's get into that.
Yeah, first of all, I want to touch base quickly on why the Fed would be cutting rates. Okay, what is it really trying to achieve? And we talked about this IMF report about going to zero to negative rates and why the world is doing that. Europe obviously is leading the way. They're doing it because they don't want banks sitting on cash out of fear, right, as if they have to be stable or liquid. And so they're trying to force the banks that rather than parking assets in the central bank, where they're going to get charged, they're going to now turn around and lend those monies out in the fractional reserve lending system. That's one. Two is that they're trying to stimulate spending by the part of the consumer, right? They want us borrowing and spending, and that's going to drive the economic revival, or at least stave off any sort of recession or depression.
So zero and negative interest rates are basically just a forced stimulus, and it picks up the concern of where do you keep your money that's safe? I mean, historically, I've always joked about how savings and cash is the safest way to lose money when you look at the interest rate that a bank is paying you compared to what the stated, or I would argue the real rates of inflation
Understated.
Understated rates of inflation. But nowadays it becomes a nominal issue where you're literally getting less out than you put into the bank. So what do you do with your money as opposed to keep it in the bank? Do you have to go spend it?
Well, and Miles, Tori and I have been out for the past few shows. Part of the reason we've been out is last week we were in Washington, D.C. for the FinCon conference. It's one of the largest financial technology conferences every year. So we went there representing Vaulted. I'm sure you guys have heard Vaulted mentioned on this show as well as the commentary, but what we did with Vaulted was we created a web-based app that acts as a gold-backed savings account. So it's very liquid. You put your money in there, a day later you can buy gold. You need the money out, a day later it's back in your checking account, but it's backed by gold. In order for this, Dave saw the writing on the wall with this. He saw the IMF report a few months ago, but we've known much longer that we were moving in this direction. I don't know that anybody saw that it was going to happen at this pace, to where now our president, and this all comes down to, I'm sure as everybody's seen, President Trump's tweet this morning on Wednesday that he bashing the Fed to go to negative zero or negative interest rates. So vaulted.com is a spot where you can go and you can park your savings for short term, and it will be backed by physical allocated ounces of gold.
Yeah, and the central bank obviously doesn't want you doing that. I mean, by storing your assets in physical allocated ounces, you're leaving this sort of closed financial system that they want everybody captured in, right? But the other concern they have is that everybody is going to leave the bank. So if you have significantly negative interest rates and the saver or the depositor is being stung, the issue there is they've got to balance it with a flight to cash. Okay, so that's why we've kind of said on this show, cash has a target on its back as well. But if everybody leaves the bank by holding cash, that's the only other current alternative. So all eyes will be on cash and gold.
Sure, you create a system that captures everybody, and you're the only player that can break the rules.
With that, Miles, let's move right into gold and what we saw over the past week.
So moving into gold, we did come up into the mid-1500s after that massive breakout of the old highs in the 1300s. So we're up fairly substantially. It wasn't surprising to see this pullback we've had. I did say last week when Robert and I were in here, it was possible we could see another little push up, a little three drives pattern up to around 1600 before the big sell-off. But this to me is just your technical trading. Now, I think there's an interesting correlation between what prices are doing now and the expectation of an interest rate drop next week. But for the time being, it doesn't surprise me with that expectation to see the prices selling off. I mean, we're up $200-300 in gold this summer. So to have a $50 sell-off and probably more around the corner, that's just your standard ABCD wave movement, Elliott wave theory. The timing, however, does not surprise me. I think it's very telling about what we're going to see come out of the Fed next week.
That's always the battle. I mean, we've laughed on this show about, is it technical, is it fundamental, is it news driven, or is it just price points playing out over time? And it's the timing that is always the biggest challenge. But there's a world of uncertainty out there right now, globally, not just domestically. Okay, it's not just our political scene that we're all wrapped up into. It's the global economic scene. So with uncertainty comes things like gold responding accordingly and a strong U.S. dollar. And that can actually be taking place at the same time as a rally or a robust equities market. So to see all this play out, it really is in response to and is hypersensitive to the news of the day. And in a lot of instances, it's very unpredictable. Like Trump's tweet this morning, we can't predict that's going to happen. But ultimately what it does is it gets you right to Miles's predictive price points on a technical analysis standpoint.
Well, let's move right into the white metals, starting with silver. Now, both of you guys have been adamant that you're not going to get excited about silver until it hits $20. Well, we got darn close last week to hitting that $20 mark, but we didn't. So are you excited about silver? What are your thoughts?
Yeah, and the $20 mark is that high point back from 2016, and it's a point compared to gold that gold has already broken. I mean, gold and silver have gone similar, but arguably separate directions over the last couple of years, with gold starting to make its moves up a fair bit of time before silver did, and even a fair bit of time before platinum did. And we went into that a little bit last week, some of that timing. So 20, obviously 20, that's $5 above where the entry points were. So I wasn't sitting here thinking avoid silver till it's 25 by any means. I don't want
We're
anybody
still excited.
To think that's what I was saying. But, to me, from a technical standpoint, I want to see higher highs. I want to see lower lows. And the recent higher high we've had was $20, 2016. So mid-$19 range this past week was fantastic for silver. That puts us right up into that top-end trading range before silver fell the following couple of years. So I'm very excited for silver. I'm looking for a deep pullback here. I hope I get it. I may not. We may only come down $1, but if we come down 3 or 4, that would be spectacular, especially for clients we have sitting, waiting with retirement account money coming in at the end of the year, or any, this is the time of year that you do see a lot of pickup investing, both here domestically following the summer spending months, as well as overseas and like the Indian wedding season. So to see a pickup in metals investing over the next few months, preceded by here a slight pullback in silver, may provide a heck of an opportunity based on where the ratios are.
And that's why I'm excited about silver. It's not that I just haven't bought into the theory that we're going to shoot up above the 25, right, or up into the 30s until we get a strong close above the 20. And it's not that, we haven't seen some good price action. And we have also seen a narrowing in the ratio, which is really key. We've been as high as 93 to 1 and as low as 78 to 1 here just in the last number of days. And now we're back up to 82 to 1. So that's still exciting for silver. It's still a great discount, but you're technically in a bull market because we've far exceeded the 20% up move that defines a technical bull market, right? So a lot of wind in the sails of silver, but I'm with you. I want to see the pullback prior to me feeling like, man, you better jump on the bandwagon now or you're going to miss a $10 move.
Yeah, and you've got to get those sell orders to shake out so that you can get past those prices. And that's what you see on these types of pullbacks. So silver really just needs to stay above like $15. I mean, it's got a long way to go down and still be pretty arguably bullish. So silver is still the sleeping giant that's starting to wake up just now. Don't think this last $5 move up in silver was anything worth getting excited about. It's what's coming around the corner that you should be really getting ready for.
Well, and Tori, you briefly mentioned the ratios, and Miles, you had mentioned as well that gold started this run before. That was when gold moved up, that's when we saw that ratio stretch to 93 to 1. Silver started to pick up the pace, and as we know, silver will move faster than gold when we really get rocking, and that's when we saw that correction back down into the 70s.
That's right.
Now we're back at that 82 to 1 ratio as we sit today. Platinum palladium ratio is about 0.6 to 1, as well as the platinum to gold ratio, still sitting at 0.6 to 1. It's very important to pay attention to these ratios if you want to compound ounces in your precious metals portfolio.
Yeah, and platinum's had, we're flat sort of week over week, but that's with a lot of volatility. There's about $50 volatility in the platinum price in 1 week, but nothing like the palladium price. Palladium's up $100 in September so far, essentially, and so we are seeing those white metals also join the party here a little bit. You want to get into the technicals there, Miles, a little bit?
Well, the platinum chart looks a heck of a lot like the silver chart. Just again, gold started the charge first. Silver has followed up, 6-8 months later. Platinum's just starting to get moving now. I think the last guys to the game beat the first guys to the game percentage-wise when it's all said and done. I mean, I think that's why we've been arguing a solid silver position and a platinum position to complement the gold that you should always have because of the inflation reason we talked about previously. So platinum looking a lot like silver, just more volatile. Palladium, on the other hand, looks a lot like the Dow. Palladium's trading just like any industrial metal, and it's not surprising to see it moving and continuing to move like the Dow. So it should continue to see those prices just compress between each other, that ratio get tighter, and ultimately I do think platinum beats palladium again.
And all of these moves, Miles, in the metals right now are coinciding with a dollar that's somewhat stagnant. But we got the question asked a lot to us at FinCon of why do you own gold? If anybody ever asks you, just show them this chart right here, and this will explain everything you know about why you own gold and why Miles said that all of these other things are just a complement to owning gold.
Yeah, it's also coinciding with a lot of continued volatility in oil, which is down another 2.5% today. It's at 55.96, I think, right now, a barrel. And that U.S. oil is compressing at the 55 to 56 range. Is there going to be a breakout? We don't know. But just like gold, oftentimes oil can be a barometer of economic health, right? And so we're going to have eyes on oil as well. But hopefully, all said and done, it's been stuck in this range too, and we'd really like to see it break out to the upside. That would be bullish for gold.
Right. Watching oil is for the same reasons that I like to watch the transports compared to the Dow. If you're not actually moving stuff, it becomes irrelevant what the stock price is. If you're not selling something, it ain't worth anything.
We've got a lot going on fundamentally in the markets. Actually, starting tomorrow, we've got the European Central Bank's meeting tomorrow. They're going to announce their rate cut, most likely. Followed by next week, we'll have the Federal Reserve, which is going to meet and most likely do the same thing. But Miles, is this priced into the markets right now, or are we going to start to see some action starting tomorrow with Europe?
Well, I think the dollar should creep up with the euro rate cut a week ahead of ours. So it wouldn't surprise. I mean, the dollar's been creeping up for a while now, 2 years? So pushing closer and closer to that 100 mark and probably continue to move that way. I, of course, like I mentioned earlier, I think gold is selling off right now in anticipation. I think there will be a reactive move following a rate cut, following an expectation of deeper inflation. And there will be a bump up in the gold price in correspondence to that next week. While this sell-off this week, there are some technical reasons. I do think this one is more fundamental. I will agree with that. Now, I think it's in reaction to the expectation. So yes, to some extent it is. Now, on the flip side of that, because the Dow has no leverage coming from the regular markets, the only thing moving the Dow right now is borrowed money. I believe the Dow price is priced in based on the expectation of a rate cut. We're pushing into that top end of the long-term trading channel, and sure, we may get a reactive knee-jerk bump Wednesday afternoon, maybe up a couple hundred points, but my forecast for the Dow over the next month is definitely down to test the low end of that trading range we've been in.
Yeah, I don't think that the dollar's going to move much next week either on a potential rate cut if they don't do more than a quarter point. Let's say they leave it alone, or they only cut a quarter point and the president's unhappy. And I think the dollar stays right here where we've been, to Eric's point.
And if they don't lower interest rates, I'd expect the equities market to just get crushed.
I would too, and gold will rally strongly. Again, sitting in a flat dollar market.
Right.
Before we wrap it up, 2 interest points. Forward credit rating was cut by Moody's to junk, and I think to me that's indicative of the automotive sector in general. Again, a barometer as to economic viability, which is weak. And then secondly, geopolitically, Bolton is out at the National Security Administration. And so I think we're going to see a change in the directions taken with both Iran and North Korea there. And that obviously will have an impact on the gold price. And we'll be following that in the weeks and months to come.
So that's going to do it for Golden Rule Radio. We appreciate you stopping by. And in anticipation of our rate cut next week, hold on to your horses, buckle up, and get ready. We'll be here with you next Wednesday when we get the Fed announcement and watch the markets go haywire. In the meantime, if you like joining us each week, please click that subscribe button, ring the bell for notifications. Head on over to our website, McIlvaney.com. Facebook, McIlvaney Financial, or Twitter at ICA Gold. And as always, if you want to sit down with one of our advisors at McIlvaney ICA and discuss your personal precious metals portfolio, you can give us a call at 1-800-525-9556.
Thanks for listening. Have a great week.